Hi, this is Dora Delels with ThoughtsOnTheMoney.com. Welcome back to my vlog. For today's session, I don't have any images from 10 years ago, but I can tell you that at this time, 10 years ago, I was looking for a job, as were many people. And to try to find a job around the holiday season is next to impossible. So basically, we all had to wait it out until the beginning of the following year. But what happened because of the job losses and the basically stoppage of consumerism because of the fears in the economy, the stock market hit a bottom in March of 2009. It actually created a tremendous buying opportunity, and by that time I had started a new job and I took advantage of that as well. I'll give you an example. GE had really dropped in price, and I felt that a company like GE was going nowhere. And when I saw the stock price go down to $7, I watched it for a few days, and it actually went down to $6.60. So by the time I bought it, I did buy 1,000 shares at $7 a share, and it doubled in about 4 months. And I used that money to pay off a fairly hefty car loan that I had at the time, because when I got laid off, it was completely unexpected. I had started a new job, I was at my peak pay, and I had taken on this car loan. So I took advantage of that opportunity to generate some income, and I was able to pay off that loan. If you're paying attention to the stock volatility lately, you may be able to find some equally good bargains in stock prices. And by the way, GE is below $10 again. So what I want to talk about today is the recent interest rate increases and why it's important. So you might have heard the alarm bells going off with the latest announcements of the rise in interest rates. And basically, interest rates have been historically low since the 2008 economic crash. And most people seem to have actually forgotten that we have an interest rate at all, mainly because savings type accounts earn pennies. They don't generate the type of interest income that's really anything to get excited over. And interest rates don't make for the most exciting topic. I have a friend that rolls her eyes every time I talk about the economy, but little does she realize that the interest rate has actually far-reaching tentacles, and I want to talk about some of that. So I want to point out again, we've basically been on an interest rate holiday since the Great Recession. And if you look at the article that I have posted on my blog, it indicates that Mesopotamians paid higher interest rates in the year 3000 BC. So that's a fun fact. So the interest rate is the cost of borrowing money, and almost everyone uses it one way or another. Small businesses pay interest for short-term loans to float their payroll, banks lend money to each other, and large businesses invest their idle cash to earn interest. The most obvious is credit card and personal loan interest taken on by consumers. The Federal Reserve controls the economy by regulating the interest rate. They raise or lower the interest rate to stabilize consumer prices or maintain a labor market that employs the most citizens. They can contract or expand the flow of money by adjusting the cost of capital. The interest rate triggers some hidden changes as well. And to me, I consider that the general happiness level. And that's because, and it seems fairly broad, but if you look at the far reach of the cost of borrowing money, it's basically baked into rent, payroll, cost of utilities, and cost of all products. So in addition to everything costing more, the latest fear factor is that the housing market is going to drop because of the increase in mortgage interest rates. Any consumer loan payment is also going to increase. And the reason why that's major news is because of the very low interest rate that we've been experiencing for the past 10 years. So now, new purchases will require more thought and consideration than before for both consumers and businesses. So let me give you an example. For a $10,000 loan, when I first purchased my car back in 1986, my first new car, and I took out a loan, the interest rate was 9.9%. The interest rate on a car loan now, let's for example say it's 3%. So on a typical 5-year loan at that $10,000 principal amount, the difference in the monthly payment would be $32, an 18% difference. And while that doesn't sound like much per month, over the course of the loan, the borrower is essentially paying $2,000 more for the same purchase. And that's significant on a $10,000 asset to pay 20% more for the cost of the asset, and it's only an interest cost. So the same occurs with a home mortgage, only on a larger scale. The housing market is directly impacted as higher mortgage payments may make home buying out of reach for some people. Therefore, as interest rates increase, there is typically a stampede to close on fixed mortgage rates. Adjustable mortgage rates should be avoided entirely when interest rates are in the increase phase. Adjustable interest might be an option when interest rates are going down, not when they're going up. And that's because the initial payment may be affordable, but as the rate adjusts at the end of the teaser period, the payments may become dangerously high, leading to financial stress and possibly foreclosure. So I've included on my blog page a loan analysis worksheet that you can pop in numbers and see what the payment would be. And you can play around with it with the different interest rates, and it's a useful tool. So let's continue. Stocks and bonds also are affected by the interest rate, and that's because the interest rate triggers insecurity with the economy, and it gives emotional investors a reason to sell. It's also tied to a business's net profits on two levels. Consumers tend to buy less, directly affecting the top line or the business's revenue. And because businesses are paying more for equipment and materials, the business's bottom line is less, therefore earnings per share is lower. As for bonds, interest rates earned on currently owned bonds may not be competitive with a higher interest rate of a no-risk account, such as a savings account. So here's an example of when an investor buys a 10-year bond with a 4% interest rate. So they're earning 4% on interest every time that bond makes an interest payment. But when the interest rate goes up, and let's say, for example, the interest rate now is 6%, that person could be earning 6% in a savings account with no risk, as opposed to 4%. And a bond, like every other financial instrument, does have some risk associated with it. So the value of that bond with its risk and the 4% interest rate, if it's held to maturity, loses value because that same investor could be putting their money into a no-risk savings account and earning 6% in interest. So even if they wanted to sell the bond before the maturity date, the bond would mostly likely sell at a loss due to the lowered value. So the winners of the interest rate increases are credit card companies, lenders, and fixed income earners. Okay, so for her friend that rolls her eyes at me, she fails to realize how much an interest rate creep could potentially affect her son. Less hiring and higher costs for everything may delay or stifle his ability to get out on his own, become a homeowner, and start making large financial purchases that typically happen in the middle period of an adult's life. So I also included on my blog post an October 1st, 2018 interest article that discusses the potential environment now for more frequent interest rate increases. It's a very interesting article. So I consider interest to be throwing money away. But when you have no money, you may have no choice but to borrow and pay interest. And, that's perfectly understandable, but as you move through life and you build up earnings and assets, your goal should be to avoid paying interest as much as possible, because it's money that you're never going to get back. It's money thrown away. You can't deduct it on your tax return. You used to be able to do that before 1986, but that law is long gone. So paying interest should be avoided, and the best way to avoid paying interest is by having paying in cash or having the highest amount of a down payment for any asset being purchased, and then paying off a loan as quickly as possible. Okay, so my next topic is why you would need a will. And people that need a will, it would generally start if you own any assets or if you have children. That's pretty much almost anybody. But it's also really important to avoid discord among family members after passing. And, you know, if the thought of your family members fighting and arguing over everything and, you know, filing lawsuits against each other, if that makes you happy, then, you know, a will, you know, you can forego doing a will. But for anybody else that really would not want that to occur after their passing, should write a will. And when you write the will, you alleviate the potential for a family feud, even over the smallest items. Aretha Franklin and Prince both did not have a will, and as a result, Aretha's estate is going to be tied up in court for the next several years. And while the family members fight over every last dollar and remnant, the winners will be the lawyers. So name beneficiaries carefully and make sure they're updated. That's basically the point of doing a will. Designating beneficiary names and specific individuals for you to pass your assets on to. So the next really critical topic is avoiding probate court. And probate is a legal term, and it's assets that basically become homeless after the death of the owner. They have no legal title, and if they have not been named in a will, they end up in probate court. Cue the legal eagles. Assets that do have a beneficiary designation avoid the legal interference. By having a specific beneficiary designation, they get in the fast lane and automatically transfer to the new owner upon death. Assets not in probate get on the slow bus to the nearest courthouse. So assets that have a named beneficiary are those accounts such as IRAs, 401ks, joint accounts, trusts, and etc., where you would typically name a beneficiary when the account is opened. So, for example, when a person opens an IRA, on the application for creating the account, they have to name a beneficiary. For a 401k, you're required to name a beneficiary. A trust always names beneficiaries. That's the nature of that instrument. So by ensuring that assets without a named beneficiary are appointed to a new owner in the will, you save time, aggravation, and cost to your survivors. And one other point I wanted to make is that you should update the beneficiaries very carefully. They could be people that over a period of time they pass away. They could, die suddenly, die unexpectedly. Or it could be people that are no longer in your life. Maybe they've moved away, and it's just more practical for you to name a different beneficiary that's closer to home or closer to the people that you would like to pass your assets to. So I hope this is helpful. I highly recommend doing a will once you do start owning and building up assets. And please leave feedback and comments and questions on thoughtsonthemoney.com. Next time, I'm going to be talking about the best gift that you can give your children. So thanks, and I'll see you next time.